Just because you can afford a property, just because you're making the numbers that I'm mentioning here, doesn't mean you should actually spend that amount on the house. So you're starting to think about making your next move in Ottawa, whether that's moving up from a rental to buy your first property or selling a condo to move into something with a little more space, but you're not really sure where affordability is at right now. It's a valid question. Affordability in Ottawa and in the Canadian market in general has been rocky the last few years. It's been a wild ride. And while prices are down from the peaks that we had in the... There's a garbage truck. There's a garbage truck outside. Okay, I think we're good. As I was saying, affordability in Ottawa has been a rocky road in the last few years. We had the really high prices at the peak COVID years, but the interest rates were super low. And while the prices have come down since those peaks, unfortunately, the interest rates went in the opposite direction. In fact, the increase in interest rates is a large part of what precipitated the price decreases that we've seen over the last couple of years. And at the end of the day, what it comes down to is the monthly payment. So while the prices have come down, the interest rates going up have kept those monthly payments around where they were or made them go up in some cases. Because of how much has changed in the last couple of years and the fact that you've probably been hearing a bunch of different things over that time period, and if you haven't been paying close attention, it's probably been hard to keep up with. I wanted to take some time to take a look at the average price of each major property type in Ottawa: condos, townhouses, and single-family homes. We're going to start by looking at what the average price of each of those property types is, and then we're going to look at what you would have to be making either as an individual or as a household, depending on your situation, in order to afford to buy that place, in order to afford to get the mortgage. Now, right off the bat, I want to mention a couple of things. The first is that I'm going to be using general numbers here. This is not a replacement for going and speaking with a bank or mortgage broker and getting a real pre-approval. They're going to be able to look at your individual situation, what your sources of income are, what your debts are, and give you a much more precise number than I am able to today. Today, I'm going to be working in generalities. The second thing I want to mention off the bat here is just because you can afford a property, just because you're making the numbers that I'm mentioning here, doesn't mean you should actually spend that amount on the house. I always tell people when I'm working with them that there's two numbers you have to think about when you're thinking of affordability. The first one is what the bank is actually going to pre-approve you for, but the second and more important one is the number that you can look at every month, the monthly payment, and be comfortable paying that, because you're going to be paying it for at least the next 3 to 5 years. It's not just about getting a pre-approval and then buying at the top of that pre-approval because you're confident prices are going to continue to go up. That is not an assumption you should be making, even though historically they have in Ottawa. There's no guarantee that that's going to continue. You have to make sure that you're not going to make yourself house poor with this purchase. With all that being said, let's get into the information. I've tried to keep this as general as possible, and I tried to avoid using more numbers and calculations than I had to, but unfortunately that's a little difficult when you're talking about affordability and mortgage payments, but I tried to make this as painless as possible. Now, a couple of assumptions that we're going to be making in the following examples, just to make things a little bit simpler, is that there's no additional debt in these scenarios. The only debt this person's going to be taking on is their mortgage amount. The mortgage rate we're going to be using is 4.7%. And whenever the bank or mortgage broker is qualifying you for a mortgage, there's two key ratios they're going to be looking at. The first is the GDS, or gross debt servicing ratio. This basically says that the total amount that you spend on housing every month can only be up to 39% of your total monthly gross income. TDS is similar. It stands for total debt servicing ratio. This takes the housing costs that the GDS takes into consideration. So the mortgage cost, the property tax, the utilities, that sort of thing, condo fees if applicable, and it adds any other debt to that. So things like a car loan or a personal loan. And all of those debts combined with your housing costs can't be any more than 44%. Now, as I mentioned, the assumption we're making here is no debt. So it's really just the GDS we're going to be looking at. But in many scenarios in real life, a lot of people have some debt other than their mortgage. So the TDS is going to be a factor as well. And you do have to fit within both of those ratios in order to qualify for the mortgage. And just to make this a little more clear, we're going to use an example of somebody who makes $100,000 in annual income. If we take that $100,000 and divide it by 12, that gives them a gross monthly income of approximately $8,333. So the GDS limit for this person would be that 8,333 multiplied by 39%, 3,250. So basically, when they're qualifying for a mortgage, all of the housing costs, including the mortgage amount, the property taxes, utilities, condo fees, can't total more than 3,250 if you're making $100,000 per year. Similarly, the TDS ratio is that same number, 8,333 multiplied by the 44% limit. That gives you 3,667. So all of the housing expenses plus all of their additional debts that they're carrying can't total more than that amount. Now, looking at the most recent stats in Ottawa, this is where we landed at the end of June 2025 for the average price of an apartment condo, a townhouse, and a single family home. So 418,000, 571,000, and 871,000. So our examples are going to be not these exact numbers, but prices that are close to give you an idea of what you would need to be making as a household in order to qualify for one of these properties. Hey, it's Tim from the future here. Something I just wanted to clear up. My wife mentioned it when she was proof watching this video for me before I upload it to YouTube. The mortgage rate that we're using for the examples in the coming slides is 4.7%. But to calculate the mortgage amount, like what we're using to calculate the values, we're using the rate of 6.7%. And that's because we're adding the 2% for the mortgage stress test onto that calculation. So that's where that comes from. The other thing I wanted to mention is I think my calculations for monthly utilities were probably a little bit high. So the actual amounts you would need to be making might be a little bit less. But I always err on the side of being conservative so I don't overpromise. Hopefully that helps out, and back to the original unedited video. Now, the first example we're going to look at here is a condo apartment priced at $420,000, so right around the average price. The condo fee we're going to use for this example is $500 per month, which is around average. If it's an older building, it's probably going to be more than this. If it's a newer building, you're often looking at a lot less, but they do tend to go up over time. The mortgage rate is 4.7%, but we're calculating based on 2%, based on 6.7% because we're adding the 2% for the stress test. And the down payment we're looking at here is the minimum down payment of 5%. Now, just bear in mind, this minimum of 5% is only applicable to amounts under $500,000. Once you get over $500,000, the amount of minimum down payment goes up. I'll put a calculator in the description here that I used for all of my calculations here. It's the Rate Hub one. It's pretty good. You can calculate the down payment, the monthly cost, that sort of thing using that tool. So the minimum down payment, $21,000, leaves us with $399,000 once we deduct that from the purchase price. Because we're paying under 20% for the down payment, we do have to pay a CMHC mortgage default insurance premium. This is calculated based on the mortgage amount, and using that same calculator I just mentioned, you can calculate that easily. But when we add the insurance premium of $16,758, that leaves us with a mortgage amount of $415,758. Based on that, the monthly mortgage cost is going to be $2,658 plus the property tax of $350. We usually estimate about 1% of property value to be the property tax. So if we do that for the 420 and then work it out over 12 months, that's what we get for a monthly amount. The condo fee, they normally include half of the condo fee when they're qualifying you. So in this case, that would be $250. And for utilities, we estimated $250 per month, which gives us a total of $3,508 for the monthly carrying cost of this condo. So if we take that $3,508, divide it by the 39% to give us the gross monthly income that's going to be required, that lands us at $8,994 per month, which means if you multiplied that by 12, you would need approximately $108,000 total household income in order to afford this condo. The next example we're going to look at is a freehold townhouse at $575,000. So this would probably be an older townhouse condo at this price point. A lot of the newer, nicer ones are over $600,000, even pushing the $650,000 or higher mark. Mortgage rate again, 4.7%. Down payment, we're going to use 10% in this case. So we take the down payment of $57,500. We add the CMHC insurance premium because we are still under that 20%. That gives us a mortgage amount of $534,578. The monthly mortgage cost, $3,417. Property tax, approximately $479, and utilities about $450 per month. That gives us a total monthly cost of $4,346. If we do the same calculation to get the monthly income required and annual income required, we're looking at $133,716 approximately to qualify to purchase this property with this mortgage. And again, that's household income, not just individual income. And lastly, for the single family home, we're taking $875,000, which is right around the average price. Down payment, we're using 8%, which is near the minimum in this case. So it's 5% for any amount under $500,000. For any amount that's between $500,000 and $1 million, you need 10% down payment. So when you blend that together, it gives us I think it was 7.19 or something. So I rounded up to 8. This 8% down payment gives us $70,000. We deduct that from $875 to get $805. Add the insurance premium because, again, we are under that 20%. You get $838, $810. Monthly mortgage cost is going to be $5,362 with a property tax amount of approximately $729. Because it's a bigger house, you're probably going to be paying more in utilities, so I estimated about $500 per month for a total of $6,591 for the monthly carrying cost of this property. Do the same calculation, and we end up at $202,800,000 for the average single-family home in Ottawa. Now, again, these are just general examples. You definitely would want to speak with a bank or mortgage broker to get an idea of exactly how this information applies to your situation. Depending on your sources of income and what kind of debts you have, it could be different than what I'm saying here. But hopefully this gives you at least a general idea of what's attainable and what's not in today's market. I know it's not the greatest news. I do this day in and day out. And even when I crunch the numbers, I was a little bit surprised just by how unattainable something like an entry-level condo is for one person. But that just kind of is what it is right now. If you have any questions whatsoever, please never hesitate to reach out. And if you found this video useful or helpful in any way, please consider liking or subscribing so it finds its way to more people just like yourself. Thanks so much for taking the time to watch either way, and I hope you have a fantastic rest of your day. Take care.